Part 1. Direct Tax. Lesson 1. Direct Tax at a glance. Regulatory framework. Direct taxes in India are governed mainly by the Income Tax Act, 1961, supported by rules, notifications, circulars, and judicial decisions. The Central Board of Direct Taxes (CBDT) under the Finance Ministry administers direct taxes via the Income Tax Department. Assessments typically follow the financial year from April 1 to March 31. Taxes. An introduction. Taxes are compulsory payments made by individuals and entities to the government, used to fund public services and welfare. Genesis of tax. Taxation originated as a system for governments to raise revenue to fund defense, public infrastructure, law enforcement, and social welfare. Meaning of tax. A tax is a compulsory contribution imposed by the government on income, goods, services, or property to raise revenue. Key definitions. Taxpayer. Person or entity that pays tax. Assessee. Person liable to pay tax or from whom tax is recoverable. Assessment. Process of determining the tax liability. Rationale to levy tax. Governments levy taxes for financing public goods and services, roads, schools, hospitals. Controlling inflation and economic growth. Redistributing income for social equity. Protecting domestic industries. Discouraging consumption of harmful goods, e.g. tobacco. Promoting exports. Characteristics of taxes. Compulsory. Must be paid by law. No direct return. Payment is not a fee for a specific service. Non-penal. Taxes are not fines or punishments. Public purpose. Revenue used for public benefit. Enforced by law. Failure to pay invites penalties. Objectives of taxation. To generate revenue for government expenditure. To redistribute wealth fairly. To regulate the economy and stabilize prices. To encourage or discourage certain economic behaviors. To facilitate economic development. Direct versus indirect tax. Direct tax. Paid directly by the individual or company to the government. Cannot be shifted. Examples. Income tax, corporate tax, property tax. Indirect tax. Levied on goods and services, paid initially by sellers but shifted to consumers as part of price. Examples. GST, excise duty, customs duty. Simple example. Direct tax. Income tax on your salary. You pay it directly to the government. Indirect tax. GST on buying a mobile phone. You pay GST as part of the phone price, which the seller sends to government. Merits of direct tax. Progressive and equitable tax burden depends on ability to pay. Reduces income inequality. Encourages transparency and accountability. Demerits of direct taxes. Can discourage hard work if rates are too high. Complex to administer and comply with. Requires good record keeping and assessment systems. Merits of indirect taxes. Easy to collect and administer. Encourages consumption control via higher prices. Broad tax base, everyone consumes goods and services. Demerits of indirect taxes. Regressive, hitting poorer people harder. Inflationary, as cost is passed to consumers. Background of taxation system of India. Taxation in ancient times. In ancient India, taxes were levied on land and trade, e.g. agricultural produce tax, trade tariffs. Kings collected taxes to maintain armies and public works. Income tax in modern India. Income tax was introduced by the British in 1860. The present Income Tax Act was enacted in 1961. Tax laws have evolved to include corporate tax, capital gains tax, securities transaction tax, and other direct taxes. Tax structure. The tax structure includes both direct and indirect taxes. Direct taxes cover income from salary, business, property, capital gains, and other sources. Tax administration. The CBDT oversees tax policy and administration, while the Income Tax Department executes collections and assessments through regional and local offices. If detailed examples or a landmark case related to direct tax are needed, one widely cited landmark case in Indian direct tax law is Vishwanath Prasad Radhi Shyam vs. CIT 1967. This case clarified what constitutes income under tax law, stating that all receipts representing an increase in wealth are taxable unless specifically exempted. This case is fundamental for understanding taxable income. Lesson 2. Basic concept of income tax. Regulatory framework. Definition. The income tax system in India is governed by the Income Tax Act, 1961, and related finance acts passed annually through the Finance Bill, which amends tax laws to implement the union budget provisions. Finance Bill is a bill introduced in Parliament to enact tax-related changes. It becomes Finance Act after Parliament's approval. Income Tax Act defines rules for charging tax, filing, assessment, and appeals. Central Board of Direct Taxes (CBDT) administers the law. Tax laws change each year in the Finance Bill to accommodate new policies. Example: the Finance Bill 2025 introduced changes in tax slabs and exemptions. Important definitions. Definition. Key terms used in income tax law, needed for clarity and application. Assessee. Person liable to pay tax or from whom tax is recoverable. Previous year. Financial year in which income is earned, usually April 1st. March 31st. Assessment year. Year following the previous year when income is assessed and taxed. Income. Earnings from various sources: salary, business, capital gains, etc. Person. Includes individual, company, firm, HUF, AOP, body politic, trustee, etc. Agricultural income. Income from agricultural activities, generally exempt from tax. Capital asset. Property held by an assessee, other than stock in trade. Simple example. Income earned between the 1st of April 2024 to the 31st of March 2025 is assessed in AY 2025-26. Concept of income. Definition. Income means the total money or value received or accrued to a person from any source during the previous year. Income includes salary, business profits, dividends, interest, rent, capital gains, etc. Income must be taxable unless exempted by law. Income may be in cash or kind like property or benefits. Inclusion or exclusion depends on whether income is capital or revenue nature. Capital and revenue receipts. Definition. Distinguishing between receipts that create or enhance capital value, capital receipts, versus those regularly earned or for expenses, revenue receipts. Capital receipt. Non-recurring, creates asset or reduces liability. Not usually taxable. Revenue receipt. Regular income earned through business, job, or services. Taxable. Examples. O sale of fixed asset equals capital receipt. O salary or rent equals revenue receipt. Expenses to maintain assets or revenue expenses like repairs, but purchase of asset is capital expenditure. Charge of income tax Section 4. Definition. Income tax is charged on total income earned by an assessee at rates prescribed by the Finance Act. Tax is charged on total income assessed under the Income Tax Act. Rates vary by type of assessee: individual, company, firm. Tax is charged for each assessment year on income earned in the previous year. Penalties and interest apply for non-compliance. Residential status Section 6. Definition. Residential status of an individual local entity determines the scope of taxable income in India. Residence affects what income is taxable in India, global or limited. Based on physical presence, number of days stayed in India. Test of residence for individual. Resident if 1. Stayed 182 days or more in previous year, or 2. Stayed 60 days or more in previous year and 365 days in last 4 years. Resident means tax on global income. Non-resident NR. Does not satisfy above. Only Indian income taxable. Resident and ordinarily resident ROR. Resident for 2+ years and 730+ days in last 7 years. Resident but not ordinarily resident RNOR. Resident but not fulfilling criteria of ROR. Tests of residence for Hindu undivided families HUF. HUF is resident if the control of the family lies in India. HUF's income worldwide is taxable only if it is resident. Test of residence for firm and AOP boy. Firm or association of persons AOP is resident if control and management is in India. Test of residence for companies. Company is resident if it is an Indian company or place of effective management. POEM is in India during the year. Guiding principles for determination of POEM. POEM means place where key management and commercial decisions are made. Used to decide company's residential status. Emphasis on actual control, not just registered office. Scope of total income Section 5. Definition. Total income includes all income received or deemed to be received in India or accrues arises or deemed to accrue arise in India. For residents, global income is taxable. For NR and RNOR, only Indian income is taxable. Income received or deemed to be received in India. Income is deemed received if credited to account in India or by Indian agent. Income accrue or arise in India. Income arises in India if source of income is in India, e.g. rent from India. Income deemed to accrue or arise in India. Section 9 specifies income considered to accrue in India even if received outside, like interest on foreign funds by Indian residents. Computation of taxable income and tax liability of an assessee. Calculate income from all heads. Salary, house property, business, capital gains, other sources. Deduct exemptions and allowances allowed by law. Apply deductions under Chapter 6A like Section 80C. Compute gross total income, and apply tax slabs rates. Subtract TDS and advance tax to get final tax payable or refund due. Landmark case. Vishwanath Prasad Radhishyam vs. SID 1967. Defined income broadly to include all receipts except those specifically exempted. It established that income includes not only money but any increase in wealth. This case is foundational for tax principles. Lesson 3. Incomes which do not form part of total income. Introduction. Definition. Some incomes are not taxable under the Income Tax Act because they are exempted by law. These incomes do not form part of the total taxable income. Incomes which do not form part of total income. Definition. Specific incomes fully or partially exempt from tax by various sections or rules under the Income Tax Act, meaning they are excluded from tax calculation. Agricultural income Section 10(1). Definition. Income derived from agricultural activities such as cultivation, harvesting, and sale of agricultural produce. Agriculture includes activities like farming, letting land for agriculture, and processing agricultural produce to a stage where its essentials are not altered. Income from agriculture is fully exempt from income tax under Section 10(1). Example. Income from selling wheat grown on a farm is agricultural income. Rent received from agricultural land is also agricultural income. Processing to make the produce marketable does not make the income non-agricultural, e.g. cleaning or drying. Landmark case. CIT vs. Raja Benoy Kumar Sahas Roy 1945. Clarified that agricultural income includes income from land cultivation and incidental processing. Income from manufacture of rubber Rule 7A. Definition. Income from manufacturing rubber from rubber trees is exempt to encourage this agricultural activity. The exemption applies only if the manufacture is from natural rubber latex from trees owned by the assessee. This income is treated as agricultural income for tax purposes and exempt. Income from the manufacture of coffee Rule 7B definition. Income from mild processing of coffee like curing coffee beans done by a grower is exempt. Mild processing includes activities like washing, drying, or curing coffee beans. Such income is treated as agricultural income and exempt. Income from growing and manufacturing of tea Rule 8. Definition. Income from growing tea and the mild processing by the grower is exempt. Mild processing of tea leaves does not change agricultural nature of income. Income from sale after such processing is exempt as agricultural income. Income from farm building. Definition. Income from buildings on agricultural land used for agricultural purposes is treated as agricultural income and exempt. Example. If a farmer rents a building used for storage of farm produce, rent received is agricultural income. Combination of agricultural and non-agricultural income. When agricultural income is combined with non-agricultural income, only the agricultural income portion is exempt. For tax computation, agricultural income is excluded, but it may be considered for rate purposes in some cases partial tax benefit. List of incomes which do not form part of total income. Agricultural income Section 10(1). Share of profit from a partnership firm. Dividend income from domestic companies up to limits. Certain allowances to government employees. Gifts received from relatives or on certain occasions. Scholarships granted to meet education expenses. Certain types of interest income, if specifically exempted by law. Lesson 4. Income under the head salary introduction. Definition. Income under the head salary includes the total earnings received by an individual from an employer for services rendered, including wages, allowances, perquisites, and retirement benefits. Salary income is taxable under the Income Tax Act. It includes any payment or benefit received due to employment, whether in cash or kind. This head applies to individuals only. Basis of charge Section 15. Definition. Section 15 states that salary income includes any wages, annuity, gratuity, or advance salary received from an employer. Salary income is charged on all forms of remuneration for employment. Includes salary, wages, fees, commission, bonus, perquisites, and profits in lieu of salary. Income is taxable in the year it is received or due, whichever is earlier. Impact of Section 115 BAC under the head salary. Definition. Section 115 BAC provides an optional concessional tax regime for individual taxpayers, with revised tax slabs and no exemptions deductions except NPS and employer's contribution to PF. Taxpayers may opt for this regime for potentially lower tax. Under this, exemptions like house rent allowance HRA and leave travel concession LTC are not allowed. Suitable for taxpayers with minimal exemptions. Constituents of salary Section 17. Definition. Section 17 defines what constitutes salary including basic salary, allowances, perquisites, and profits in lieu of salary. Basic salary and wages. Dearness allowance if forming part of salary. Commission on business. Bonus and overtime wages. Allowances relating to employment. Perquisites or profits in lieu of salary. Allowances. Definition. Monetary benefits given to employees to meet specific expenses or conditions related to employment. Common allowances. House rent allowance HRA, conveyance allowance, medical allowance, etc. Some allowances are fully taxable while some are partly or fully exempt as per income tax rules. Partly taxable allowances. Allowances like HRA or conveyance are taxable only to the extent they exceed the exempted limit computed under income tax rules. Example. HRA exempt up to lowest of actual HRA received, rent paid minus 10% of basic salary, or 50% 40% of salary based on city. Leave travel concession Section 10.5. Definition. Reimbursement of travel expenses incurred by an employee and family on leave is exempt if conditions are met. Exempt for travel by air, rail, or road within India. Only for travel expenses, not food or sightseeing. Can be availed twice in a block of 4 years. House rent allowance Section 1013A. HRA received by an employee is exempt subject to limits based on city of residence, actual rent paid, and salary. If employee does not pay rent or lives in own house, HRA is fully taxable. Special allowances Section 1014. Allowances granted for specific purposes like uniform allowance, children education allowance, conveyance, and others. Certain specified allowances are exempt within limits. Others are taxable. Annuity pension. Pension received post-retirement is taxable under salary head. Commuted pension lump sum received instead of monthly pension has partial or full exemption depending on rules. Gratuity Section 1010. Gratuity is a lump sum received by an employee on termination of service. Exempt up to specified limits e.g. for government employees, fully exempt, non-government cap based on salary and years of service. Leave encashment Section 1010AA. Amount received for leave not availed is exempt when paid at retirement or termination. Limit on exemption varies between government and non-government employees. Compensation on voluntary retirement Section 1010C. Compensation received on voluntary retirement is exempt up to specified limits. Exemption reduces if gratuity or pension is also received. Perquisites Section 17.2. Definition. Benefits or advantages provided by employer, like rent-free accommodation, car, loans at concessional rate, or stock options. Perquisites are taxable unless specifically exempt. Valuation rules apply for taxable perquisites. Example. Rent-free houses value is taxable as per prescribed formula. Profits in lieu of salary Section 17.3 amounts received instead of salary, e.g. compensation for loss of job, payment for non-compete agreements. Fully taxable under salary head. Provident funds, treatment of contributions and money received. Employee's contribution to provident fund not taxable. Employer's contribution exceeding 12% of salary is taxable. Interest on provident fund is tax exempt up to limits. Amount received at retirement may be exempt or taxable depending on fund type. Relief when salary is paid in arrears or advance Section 89. Relief granted to avoid hardship arising from salary received for multiple years in 1 year arrears or advance. Taxes computed as if income was spread over years. Deductions from salary. Standard deduction allowed e.g. 50,000 rupees as of recent tax laws. Professional tax paid is deductible. Entertainment allowance and family pension deduction limits apply. Computation of salary income. Start with gross salary basic plus allowances plus perquisites plus profits in lieu of salary. Deduct exempt allowances, deductions, and allowable expenses. Apply tax rates on net salary income. Landmark case. CIT versus R.K. Jane 1987. Clarified that salary includes all monetary and non-monetary benefits connected with employment. Established that perquisites and profits in lieu of salary are taxed as salary income. Lesson 5. Income under the head house property. Basis of charge Section 22. Definition. Income under the head house property is charged to tax on income derived from owning a house or land which is not used for business or held as stock in trade. Covers income from rent or deemed rent of property owned by the assessee. Taxable even if property is not actually let out but considered available for rent. Deemed ownership Section 27. Definition. Even if the property is not legally owned, an individual may be deemed the owner for tax if they have certain rights or possession. Includes someone entitled to receive rent or possession under contract. Also covers those who receive usufructuary interest right to use and enjoy property. Property held as stock in trade. Property held specifically for sale in course of business is treated as stock in trade, not house property. Income from such property is business income, not house property income. Concept of composite rent. Composite rent is inclusive of rent for land and buildings. Income chargeable under house property is only for building rent. Land portion is exempt unless developed or held as business asset. Impact of Section 115 BAC under the head house property. Section 115 BAC's concessional tax regime affects tax calculation but the treatment of house property income remains largely unchanged except exemptions and deductions are restricted. Determination of annual value. Definition. Annual value AV is the income chargeable under house property, generally the rent received or receivable or higher of expected rent or actual rent. Determined as the higher of. O rent actually received or receivable, or O reasonable expected rent from property, or O municipal value or fair rent, whichever is highest. Where the property is let out for the whole year section 23(1). Annual value is rent received or receivable. If property is let for entire year, income is based on actual or expected rent. Where let out property is vacant for part of the year. Rent not received during vacancy is excluded from income. Vacancy period affects rent receivable but does not reduce expected rent. Where property is self-occupied unoccupied section 23(2). If property is self-occupied the annual value is deemed to be nil. No income from such property but interest on housing loan is deductible up to a limit. Where property is partly let out and partly self-occupied during PY section 23(3). Income from let out portion computed normally. Self-occupied portion treated as nil annual value. Deemed to be let out property section 23(4). Owners of certain furnished or commercial properties may be deemed to have let out property even if unused, attracting tax on notional rent. Notional income from house property held as stock in trade section 23(5). If property held as stock in trade isn't sold but rented out, income from rent is taxable. If not rented, no income under house property but business income is applicable on sale. Deductions from net annual value section 24. Deduct municipal taxes paid by owner. Deduct 30% of net annual value as standard deduction for repairs and maintenance. Deduct interest paid on loan for purchase or construction of property subject to limits. Summary of computation of income from house property. Determine gross annual value GAV based on rent or deemed rent. Subtract municipal taxes to get net annual value NAV. Deduct 30% of NAV as standard deduction. Deduct interest on housing loan. Result is taxable income from house property. Inadmissible deductions section 25. Deductions not allowed for expenses like personal expenses, costs for earning income under other heads, or capital expenditures. Treatment of unrealized rent or arrear of rent section 25A. Unrealized rent or arrears can be claimed as a deduction if steps to recover the rent are taken. Income from company-owned property section 26. Income from house property owned jointly is divided among owners in their sharing ratio. Each owner is taxed on their share of income. House property incomes, exempted from tax. Agricultural land attached to the building. Income from letting property used for charitable or religious purposes. Income from government buildings meant for public purposes. Simple example. If an individual owns a rented house for 12,000 rupees per month rent, total rent receivable is 144,000 rupees per year. Municipal taxes paid Rs. 12,000. GAV equals Rs. 1. 44,000. Less municipal taxes equals Rs. 12,000. NAV equals Rs. 1. 32,000. Less 30% standard deduction equals Rs. 39,600. Interest on housing loan equals Rs. 30,000. Taxable income equals Rs. 1. 32,000 39,600 30,000 equals Rs. 62,400. Landmark case. CIT versus Raja Benoy Kumar Sahas Roy 1945. Recognized rights of deemed ownership in agricultural and house property income taxation. CIT versus Nair Service Society Limited. 1968. Clarified principles on ownership and possession for tax purposes. Lesson 6. Profits and gains from business and profession. Business, or profession. Definition. Business refers to any trade, commerce, manufacturing, or adventure in the nature of trade carried on to earn profits. Profession is a vocation requiring special knowledge and skill, such as doctors, lawyers, accountants. Key points. Business includes manufacturing and trading, whether lawful or legal taxable. Profession involves continuous, systematic work with specialized knowledge. Profit motive is important but not the sole factor for taxation. Example. Running a shop business. Practicing law profession. Income chargeable to tax under the head business or profession section 28. Definition. Income earned from business or profession is chargeable under this head. Includes profits and gains from business activities. Income from buying, selling goods, rendering services, or any business venture. Illegal business income e.g. bootlegging is taxable. Speculation business. Definition. A business involving buying and selling goods or securities without actual delivery or for quick profit. Income from speculation business is taxable separately. Losses from speculation business cannot be set off against other business income except speculation income. Key points for consideration. Business income includes income earned in cash or kind. Continuation of business status is required for taxation. Ownership not always necessary. Income taxable if business is controlled or benefited by SSE. Legal or illegal business is both taxable. Method of accounting section 145. Definition. Accounting method cash or mercantile adopted by SSE to calculate profits. Cash method. Income counted when actually received. Mercantile accrual method. Income counted when earned or due, irrespective of receipt. Consistency in method required. Method of accounting in certain cases section 145A. Requires valuation of purchase and sale of goods and inventory as per prescribed rules. Ensures uniformity in valuation for tax purposes. Taxability of certain income section 145B. Income from conversion of stock in trade into capital asset is taxable. Ensures income is not missed due to change in account classification. Income earned in cash or in kind. Income is taxable whether received in money, kind, or otherwise. Valuation rules apply for consideration in kind. Continuation of business or profession. SSE must carry on business profession during the year for income to be taxable. Ownership of business is not necessary for taxability. Taxable if SSE is entitled to income or controls business even if not owner. Business may be legal or legal. Income from both types taxed. Illegally earned income not exempt. Profit motive is not the sole consideration for taxability. Even if no profit motive, income from business may be taxable. Computation of income separately for each business. Income from different businesses or professions is computed separately. Business income not taxable under the head business or profession. Certain incomes like capital gains or dividends excluded from business income. Computation of profits from business or profession section 29. Profit equals gross receipts. Allowable business expenses and deductions. Admissible deductions. Rent, rates, taxes, repairs, insurance on building used for business section 30. Repairs and insurance for plant, machinery, furniture section 31. Depreciation on assets used section 32. Rent, rates, taxes, repairs and insurance for buildings Section 30. Expenditure incurred for buildings used in business are deductible. Repairs and insurance for plant and machinery, furniture Section 31. Repairs and insurance expenses for machinery furniture used in business are deductible. Depreciation Section 32. Deduction allowed for wear and tear of tangible assets used in business. Based on written down value WDV of asset blocks. Additional depreciation may be allowed for new machinery. Actual cost Section 43(1). Actual cost of assets for depreciation includes purchase price and expenses incidental to acquisition. Written down value WDV Section 43(6). WDV equals cost minus depreciation claimed till date. Used to calculate depreciation for current year. Unabsorbed depreciation. Loss due to depreciation exceeding profits can be carried forward to subsequent years. Depreciation on straight line basis. Allowed in some cases but mostly WDV method applies. Terminal depreciation. Minimum depreciation allowed when no further addition to block of assets. Balancing charge Section 41(2). Chargeable when assets sold for more than WDV, excess treated as income. Additional depreciation Section 32(1) IA. Extra depreciation allowed for new plant and machinery in manufacturing business. Calculation of written down value of a block of assets Section 43(6). Total WDV of asset block after considering additions, deletions, and depreciation. Tea Coffee Rubber Development Account Section 33AB. Deduction allowed for contributions to development funds for these industries. Computation of business income in cases where income is partly agriculture and partly business. Income to be bifurcated as per nature and taxed accordingly. Lesson 7. Capital gains. Introduction. Definition. Capital gains are profits or gains arising from the transfer of a capital asset. It is a distinct head of income under the Income Tax Act. Gains made from selling property, shares, or other capital assets are called capital gains. Taxed separately from salary or business income. Chargeability Section 45. Definition. Section 45 states that any profits or gains arising from transfer of capital assets during the previous year are chargeable to tax under capital gains. Tax applies only on gains, not on the full sale amount. Gain equals sale price, cost of acquisition, expenses related to transfer. Capital assets Section 214. Definition. Capital asset means property of any kind held by an SSE, whether or not connected with business or profession. Includes land, building, shares, securities, bonds, goodwill, patents, machinery, etc. Excludes stock in trade inventory, agricultural land in rural areas for individual farmers, certain bonds, etc. Transfer Section 247. Definition. Transfer includes sale, exchange, relinquishment, extinguishment of rights, compulsory acquisition, or any transaction resulting in transfer of capital asset. Includes transfer by inheritance or gift if it falls under certain conditions. What does not constitute transfer? Transfer under a will or inheritance. Certain transactions like conversion of bonds, amalgamation of companies under conditions. Mode of computation Section 48. Capital gain is computed as sale consideration amount received, O cost of acquisition, O cost of improvement, O expenses on transfer. Equals capital gain short-term or long-term. Gains are classified as short-term or long-term based on holding period. Long-term gains generally have concessional tax rates. Ascertainment of cost in specified circumstances Section 49. Rules for calculating cost when original cost is not available or when assets are acquired in special ways e.g. gift, inheritance. Year of chargeability is capital gains. Capital gains are charged in the year in which the transfer happens. Capital gains for depreciable assets Section 50. Special provisions for assets on which depreciation is claimed. Gains on such assets are calculated by adjusting the written down value. Capital gains in respect of slump sales Section 50B. If a business undertaking is sold as a whole for a lump sum, gains are computed under Section 50B. Computation of capital gain in real estate transaction Section 50C. Fair market value FMV as declared by Stamp Valuation Authority is considered as sale consideration if it exceeds the sale price. Capital gain on transfer of unlisted shares in a company Section 50CA. FMV of unlisted shares is taken as full value of consideration if it exceeds actual sale price to avoid undervaluation. Exemption from capital gains. Various exemptions are given under the Act if capital gains are reinvested in specified assets within prescribed time limits. Examples of exemptions. Profit on sale of residential property reinvested in another house Section 54. Transfer of agricultural land used for agriculture Section 54B. Investment in specified bonds for gains from sale of property Section 54 EC. Investment in residential house other than original asset Section 54F. Practical example Section 54. If you sell your house and get a capital gain of 10 lakh rupees and reinvest it into buying another house within 2 years, the gain is exempt from tax under Section 54. Landmark case. CIT versus Raja Benoy Kumar Sahas Roy 1945. Defined capital asset and clarified meaning of transfer for capital gains tax. CIT versus Manoharlal Vithaldas 1967. Explained cost of acquisition concept. Lesson 8. Income from other sources. Basis of charge of income from other sources Section 56. Definition. Income from other sources is taxable if it does not fall under any other head of income like salary, house property, business, or capital gains. Catch-all category for residual income not classified elsewhere. Includes interest, dividends, winnings, gifts above limits, rents, etc. Taxed at normal slab rates. Casual income Section 562 IB. Definition. Income from lottery winnings, crossword puzzles, racehorse winnings, gambling, betting, and other specified sources. Fully taxable at flat rate of 30% without deductions. No set-off or carry forward of losses allowed. Example. Winning 50,000 rupees from a lottery is taxable under this section. Example of income that will be taxable under the head other sources. Interest earned on savings bank account or fixed deposits. Dividends received other than exempted dividends. Rental income from subletting property if not under house property. Gifts received exceeding 50,000 rupees in a year from non-relatives. Family pension received after death of government or private employee. Income from family pension. Pension received by family members after death of the employee is taxable under this head. Deduction allowed up to 15,000 rupees or 1/3 of pension receive. Taxation of dividends. Dividends from domestic companies are taxable in the hands of shareholders. Dividends from foreign companies are also taxable under this head. Dividend distribution tax (DDT) was abolished. Shareholders now pay tax on dividends. Deductions allowable in computing income from other sources Section 57. Interest paid on loans taken for earning income from other sources. Expenses wholly and exclusively incurred to earn such income. Example, interest paid on loan taken to invest in shares. Amounts not deductible Section 58. Personal expenses unrelated to earning income from other sources are not deductible. No deduction allowed for expenses met from other income heads. Deemed income Section 59. Certain incomes are deemed under this head even if not received, such as interest credited in accounts, deemed dividends, or unexplained credits. Computation of income under the head income from other sources. Total income from all other sources is added. Deduct all allowable expenses under Section 57. Taxes charged on net income at applicable slab rates. Simple example, interest from FD, Rs. 50,000, less. Interest on loan taken to deposit FD, Rs. 5,000. Taxable income from other sources. Rs. 45,000. Landmark case. CIT versus RN. Kapoor. Clarified that income from other sources includes all residual income not specifically taxable under other heads. A. Raman versus CIT. Explained deductions allowable under Section 57. Lesson 9. Clubbing provisions and set-off and OR carry forward of losses. Clubbing of income. Definition. Provisions that combine the income of another person, e.g. spouse, minor child, or other related persons with the taxpayer's income for tax purposes to prevent tax evasion or splitting of income. Usually applies to income transferred without adequate consideration or control. Ensures income is taxed in the hands of the correct person. Examples include income of spouse, minor child, or partner being clubbed with the taxpayer's income. Examples. Income of minor child, clubbed with parent's income if the child's income exceeds 1,500 rupees month. Income transferred to spouse without consideration. Clubbed in the spouse's income. Set off and carry forward of losses. Definition. Tax laws allowing losses from one source or year to be adjusted or carried forward to reduce taxable income or gains in subsequent years. Set off. Adjusting current year's income with losses from the same source. Carry forward. Moving unabsorbed losses to future years when set off is not fully possible. Set off of losses. Key points. Losses from one head of income can generally be set off against income of the same head, e.g. business losses against business income. Certain losses can be set off against income from other heads, e.g. capital loss against capital gains. Losses from speculative business can be set off only against speculative profits. Losses from house property or other sources cannot generally be set off against business or capital gains, except in specific cases. Examples: business loss 50,000 rupees can be set off against business income of Rs. 70,000. Capital loss 20,000 rupees can be set off against capital gains Rs. 50,000. Carry forward of losses. Key points. Losses that cannot be fully set off in the current year can be carried forward. Losses from capital gains, business or profession, house property, or certain other sources can be carried forward for a specified period, generally 8 years. Must be claimed within the prescribed period. Otherwise, they lapse. Losses from speculation business can be carried forward 4 years. Examples. Business loss of 1 lakh rupees can be carried forward for 8 years to offset future profits. Capital loss from FY 2022-23 can be used against capital gains of FY 2023-24. Treatment of carry forward of losses of certain assets. Losses of companies, firms, and individuals can be carried forward subject to conditions like filing returns on time. Losses of unincorporated associations or co-owners can be carried forward if necessary legal requirements are met. Landmark case. CIT versus Shivshankar 1962. Affirmed that losses from one source can be set off against income from similar or other heads as per law's provisions. CIT versus K. Ramalinga Raju 1989. Clarified restrictions on carry forward and set off, especially pertaining to unabsorbed losses. Lesson 10. Deductions. Introduction. Definition. Deductions reduce the total taxable income of an assessee, as allowed under various sections of the Income Tax Act. Deductions encourage savings, investment, and expenses that benefit social welfare. Available under Chapter 6A Section 80C to 80U and other sections. Helps in legal tax planning and reducing tax liability. Impact of Section 115BAC 115BAD 115BA on deductions. Definition. These sections introduce concessional tax regimes with simplified slabs where most deductions and exemptions are disallowed. If assessee opts for Section 115BAC, many deductions like under Section 80C, 80D are not available. Suitable for taxpayers with minimal deductions. Normal regime allows all deductions as applicable. Deductions. Deduction in respect of investments Section 80C. Definition. Allows deduction up to Rs. 1.5 lakh on investments in specified savings instruments. Includes PPF, EPF, NSC, life insurance premiums, ELSS equity-linked savings scheme, provident fund contributions, principal repayment of home loan, tuition fees. Maximum overall limit Rs. 1.5 lakh per financial year. Example, invest Rs. 1.5 lakh in PPF. Entire amount deductible from gross income. Deduction for contribution to pension fund Section 80 CCC. Definition. Deduction for contributions made to certain pension funds. Also included in overall 1.5 lakh limit under Section 80 CCE. Deduction in respect of contribution to pension scheme of central government Section 80 CCD. Definition. Deduction for contribution to National Pension System NPS. Additional deduction up to 50,000 rupees under Section 80 CCD1B over and above 80C limit. Encourages retirement planning. Limit on deductions under Sections 80C, 80 CCC and 80 CCD Section 80 CCE. Combined deduction limit of Rs. 1.5 lakh across these sections in a financial year. Deduction in respect of contribution to Agnipath scheme Section 80 CCH. Specific deduction related to contributions under Agnipath scheme for armed forces recruitment. Deduction in respect of medical insurance premium Section 80D. Definition. Deduction for medical insurance premium paid for self, family, and parents. Deduction up to 25,000 rupees for self and family. 50,000 rupees for senior citizen parents. Additional benefit for preventive health checkups up to Rs. 5,000. Deduction in respect of maintenance including medical treatment of a dependent who is a person with disability Section 80DD. Deduction up to Rs. 75,125,000 rupees for severe disability for expenses towards dependents' medical care or insurance. Deduction in respect of medical treatment of certain specified disease or ailment Section 80DDB. Deduction for expenses on treatment of specified diseases for self or dependents. Limit varies based on age of the patient. Deduction in respect of repayment of loan taken for higher education Section 80E. Deduction on interest paid on education loan for higher education for up to 8 years. Tax incentives for affordable housing Section 80EA. Additional deduction for interest on home loan for affordable housing. Tax incentives for electric vehicles Section 80EB. Deduction on interest paid on loan for electric vehicles to encourage environmentally friendly transport. Deduction in respect of donations to certain funds, charitable institutions, etc. Section 80G. Donations to specified funds and institutions qualify for deduction 50% or 100% depending on the institution. Requires receipt, proof of donation. Deduction in respect of rent paid Section 80GG. Deduction for rent paid if no HRA received, subject to limits. Deduction in respect of certain donations for scientific research or rural development Section 80GGA. Deduction for donations towards scientific research or rural development by individuals or companies. Deduction in respect of contributions given by companies to political parties or an electoral trust Section 80GGB. Full deduction for company contributions to political parties or electoral trusts. Deduction in respect of contributions given by any person to political parties or an electoral trust Section 80GGC. Deduction for any person not company for contribution to political parties. Deduction in respect of eligible startup Section 80IAC. Income tax exemption for eligible startups for 3 years and first 7 years of operation. Deductions in respect of profits and gains from housing projects Section 80IBA. Deduction for profits from affordable housing projects by developers. Deduction in respect of profits and gains from the business of collecting and processing biodegradable waste Section 80JJA. Deduction for profits from business of waste collection and processing. Deduction in respect of employment of new workmen Section 80JJAA. Deduction for additional wages paid to new workmen. Deduction in respect of certain incomes of offshore banking units and international financial services authority Section 80LA. Deduction on specified incomes of OBIS and IFSC units. Deduction in respect of certain intercorporate dividends Section 80M. Deduction for intercorporate dividends received. Deduction in respect of income of cooperative societies Section 80P. Deduction on income of cooperative societies subject to conditions. Deduction in respect of certain income of producer companies Section 80PA. Similar deduction available for producer companies. Deduction in respect of royalty income, etc. of authors of certain books other than textbooks Section 80QQB. Deduction available for royalty income of authors. Deduction in respect of royalty on patents Section 80RRB. Deduction on income from patents granted to authors, inventors. Deduction in respect of interest on deposits and savings accounts Section 80TTA. Deduction up to 10,000 rupees on interest from savings bank accounts for individuals. Deduction in respect of interest on deposits in case of senior citizens Section 80TTB. Deduction up to 50,000 rupees for senior citizens on interest income from deposits. Deduction in case of a person with disability Section 80U. Fixed deduction available for disabled persons based on severity of disability. Rebate and relief. Rebates under Section 87A granted for individuals with income below threshold. Relief under Section 89 provided for salary income received in advance or arrears to reduce tax burden. Simple example. Investor deposits Rs. 1.5 lakh in PPF. Claims Rs. 1.5 lakh as deduction under Section 80C, reducing taxable income accordingly. Landmark case. CIT vs. Chimanlo Govinji 1957. Affirmed genuine investments qualify for deduction under Section 80C. KCS. Contractors vs. CIT 1965. Clarified conditions for claiming deduction under expenses. Lesson 11. Computation of total income and tax liability of various entities. Introduction. Definition. This lesson deals with calculating total taxable income and tax payable by different types of taxpayers including individuals, Hindu undivided families HUF, firms, associations, and cooperative societies under applicable tax laws. Tax computation combines income under all heads minus deductions and exemptions. Different entities have specific rules for income aggregation and tax rates. Tax rates for FY 2023-24I 2024-25. Varies for individuals, HUFs, firms, companies, cooperative societies. Includes slab rates, surcharge, and cess. New concessional regimes introduced for individuals HUFs AOP under Section 115 BAC. Special tax regime for individuals, HUFs, AOP, BOI, artificial juridical person Section 115 BAC. Definition. Optional concessional tax regime with reduced slab rates but without most deductions exemptions. Offers simplified tax calculation. No deductions under Chapter 6A allowed except NPS and Employers' Provident Fund contribution. Suitable for taxpayers with minimal deductions or straightforward income. Special tax regime applicable to cooperative societies Section 115 BAD. Provides concessional corporate tax rate of 22%, subject to conditions and without exemptions. Tax on income of certain new manufacturing cooperative societies Section 115 BA provides concessional rate of 15% tax for specified new manufacturing cooperatives. Rebate Section 87A. Gives tax rebate up to 12,500 rupees for FY 2023-24 for resident individual taxpayers with total income up to 5 lakh rupees. Reduces tax liability directly. Taxation of individuals. Tax calculated based on income slabs. Includes all sources of income under head salary, house property, business, capital gains, and other sources. Deductions and rebates applied accordingly. Taxation of Hindu undivided families HUF. HUF treated as separate taxable entity. Income aggregated from all sources of HUF property business. Separate PAN required for tax filing. Position under Hindu Succession Act, 1956. Governs devolution and partition of HUF property and affects taxation. Computation of income of Hindu undivided family, HUF. Income computed like an individual but for HUF assets and receipts. Allowable deductions applicable. Partition of a Hindu undivided family, Section 171. Under partition, income earned after partition is taxed in hands of individual members, not HUF. Income prior to partition attributed to HUF. Taxation of firms. Firms are separate taxable entities. Income computed under business head. Tax rate is flat 30% plus surcharge and cess. Assessment as a firm, Section 184. Firms assessed independently. Returns filed separately from partners. Assessment of partners. Partners are taxed separately on share of income. Share of profit from firm is exempt in hands of partners. Succession of one firm by another firm, Section 188. Income and tax liabilities continue in successor firm under certain conditions. Joint and several liabilities of partners for tax payable by firm, Section 188A. Partners are jointly responsible for tax payment by firm. Firm dissolved or business discontinued, Section 189. Tax liabilities remain for dissolved firms regarding outstanding dues. Alternate minimum tax AMT, Section 115 JC. Ensures minimum tax for taxpayers with high deductions. AMT payable if it exceeds regular income tax. Taxation of association of persons, body of individuals. Taxed similar to firms but with different rules on distribution. Tax liability of association of persons, body of individuals. Income computed and taxed at entity level. Method of computing share of a member of association of persons, body of individuals, Section 67A. Share of income computed as per agreement. Taxation of share of income of a member of AOP Boy. Members taxed individually on share from AOP Boy income. Assessment in case of dissolution of an association of persons, Section 177. Specific provisions for final assessment. Taxation of cooperative societies. Separate taxation rules for cooperatives. Rate varies by type and turnover. Meaning, Section 210. Legal definition of cooperative societies for tax purposes. Computation of income of cooperative societies. Income computed similar to companies but with special deductions. Rates of income tax on cooperative society. Lower tax rates are concessional rates under specific sections. Deduction in respect of income of cooperative societies, Section 80P. Deduction available for specified cooperative incomes. Assessment of cooperative societies. Returns filed separately. Assessments done as per applicable rates. Tax exemptions to political parties, Section 13A. Income from voluntary contributions and other sources exempt if registered. Electoral trust. Special provisions for income and assessment of electoral trusts. Voluntary contributions received by an electoral trust, Section 13B. Income exempt subject to conditions. Tax exemptions for charitable trusts and institutions. Eligibility and registration criteria for exemption. Income from charitable activities exempt if conditions met. Registration of trusts. Trusts must register, Section 12 offer tax exemption. Procedure for registration, Section 12AA. Application process and eligibility for registration. Procedure for fresh registration, Section 12AB. Re-registration or fresh registration procedures. Simple example. An individual with taxable income of 7 lakh rupees opts for the new regime under Section 115 BAC and pays taxes per slabs without most deductions. Landmark case. CIT vs. Ahmedabad Municipal Corporation, 1969. Explains separate entity principle for HUF. CIT vs. Grasim Industries Limited, 1994. Clarified tax computation for cooperative societies. Lesson 12. Classification and tax incidence on companies. Background. Definition. Understand the types of companies and how corporate taxation applies under Indian tax laws. Companies classified based on shareholding and public interest. Tax rules vary according to classification and nature of company. Company in which public or substantially interested, a widely held company. Definition. A company where public holds at least 51% of the shares or voting power. Usually listed companies are large public companies. Faces more stringent disclosure and compliance norms. Enjoys limited tax benefits under stricter conditions. Closely held company. Definition. Company in which less than 51% of shares or voting power is held by public. Typically closely held by family or small group. Taxation and regulatory features differ from widely held companies. Tax incidence on companies. Definition. Companies are taxed on their total income, including business profits, capital gains, and other income. Corporate tax rates depend on turnover, type, and status of company, domestic or foreign. Includes surcharge and health and education cess. Dividend distribution and buyback of shares attract additional taxes. Corporate tax rates. Rates vary for domestic and foreign companies. Concessional tax rates for new manufacturing or startup companies. Section 115BA, 115BAA, and 115BAB offer reduced tax rates with specified conditions. Minimum alternate tax MAT. Definition. MAT ensures minimum tax payment by companies showing profit under accounting but low taxable income due to exemptions. Currently levied at 15% of book profits. MAT paid can be carried forward as credit against future tax liability. Meaning of book profits. Definition. Book profits are profits as per company's financial statements with certain adjustments. Used in MAT computation. Adjustments include adding back deferred tax, income tax provisions, etc. MAT credit, Section 115 JA. Credit for MAT paid in earlier years can be set off against normal tax payable in subsequent 15 years. Taxation of dividend. Dividend declared by domestic companies taxable in hands of shareholders. Dividend distribution tax DDT abolished. Tax on dividend now at shareholder level. Resident shareholders pay taxes per slab. Non-residents subject to TDS or treaty rates. Exemption for intercorporate dividend distribution within IFSC units engaged in aircraft leasing business, Section 1034B. Specific exemption for dividends paid within International Financial Services Centers IFSC for aircraft leasing to avoid double taxation. Taxability of dividend in hands of recipient. Residents, taxed as income from other sources. Non-residents FPIs. Subject to TDS at applicable rates. Carbon credit, Section 115 BBG. Income from carbon credit trading is taxable at special rates. Buyback of shares. Buyback triggers tax on distributed income by company. Company pays tax on buyback amount. Tax on income distributed by specified company or mutual fund. Tax applicable on income distribution by companies or funds. Equalization levy. Tax on online advertisement, e-commerce, and related services under specific conditions for non-resident service providers. Tax liability of companies in the event of liquidation. Tax on income distributed to shareholders during liquidation. Tax implications for capital gains and dividends arise on liquidation proceeds. Taxation of share premium. Share premium treated as income unless credited to capital reserve. Taxation aspects of amalgamations, mergers and demergers. Special provisions allow carry forward of losses and avoidance of capital gains tax under specified conditions. Amalgamating companies can transfer business without immediate tax liability. Carry forward and set off of accumulated loss and unabsorbed depreciation of the amalgamating company. Section 72A. Amalgamating companies' losses and depreciation can be carried forward by the amalgamated company if conditions met. Simple example. A domestic widely held company with turnover over 400 crore rupees pays tax at 30% plus surcharge. Opts for MAT if tax liability is low due to exemptions. Landmark case. CIT vs. Gujarat State Fertilizers and Chemicals Limited. 1990. Defined book profits for MAT calculations. Vodafone International Holdings BV case. Landmark International case on transfer pricing affecting company tax. Lesson 13. Procedural compliance. Introduction. Definition. Procedural compliance refers to all formalities and steps required under income tax laws to deduct, deposit, file, and report taxes properly. Ensures correct tax collection and timely compliance. Includes TDS, TCS, advance tax, return filing, and related processes. Tax deducted at source. TDS. Definition. TDS is tax collected at the origin of income by the payer, who deducts tax before paying the recipient. Reduces tax evasion by advance collection. Applies to salary, interest, rent, commission, and other specified payments. Scheme of tax deduction at source. Deductor deducts tax at prescribed rates based on nature of payment. Deducted amount is deposited with the government. Deductor files TDS returns and issues certificates to deductees. TDS chart FY 2023-24I 2024-25. Rate of TDS varies by type of payment and recipient status: resident, non-resident. Separate categories. Non-company persons, domestic companies, non-domestic companies. Category A. In case of person other than company. TDS rates specified for salary, interest, rent, professional fees, and other payments. Lower or nil rates may apply if PAN not furnished. When recipient is resident, TDS deducted at normal rates if PAN furnished. Higher or 20% TDS if PAN not provided. Section 206AA. When recipient is non-resident, TDS at higher rates or as per Double Tax Avoidance Agreement DTAA. Usually deducted at source on payments like interest, royalty, fees for technical services. Category B. In case of a domestic company. TDS applicable at prescribed rates on payments to domestic companies under specific sections. Category C. In case of a non-domestic company. Higher TDS rates on payments to foreign companies. Compliance under transfer pricing and withholding tax norms. Minimum threshold limit up to which TDS not applicable. Payments below prescribed thresholds are exempt from TDS deductions. Time limit for depositing of TDS. TDS must be deposited within 7 days from the end of the month in which deduction is made. TDS certificate. Deductor must issue TDS certificate form 16 or 16A showing tax deducted to the deductee. Due date for issue of TDS certificate. For salary form 16, issued by the 15th of June following financial year. For non-salary form 16A. Within 15 days of due date of filing TDS return. Issue of duplicate certificate. Duplicate TDS certificates can be issued if originals are lost. TDS forms and returns. Deductors must file TDS returns quarterly using prescribed forms. Returns report all TDS deducted and deposited. TDS return contains details of deductees, amount paid, TDS deducted, challan details. Refund of TDS. If excess TDS deducted, deductee can claim refund via income tax return. ETDS return. Electronic filing of TDS returns mandatory for most deductors. Tax collection at source. TCS Section 206C. Tax collected by seller from buyer on sale of specified goods and transactions. Requirement to furnish PAN by collectee. Section 206CC. PAN mandatory for deductee collectee to avoid higher TDS TCS rate. TDS TCS for non-filers of income tax return. Section 206AB 206CCA. Higher TDS TCS rate double on persons not filing returns for past 2 years. Advance tax. Definition. Tax payable in installments in advance during the financial year based on estimated income. Due dates set by government. Prevents interest liability for late tax payments. Due dates for payment of advance tax. Installments payable typically on the 15th of June, 15th September, 15th December, and the 15th of March. Payment of advance tax in case of capital gains, casual income, dividend income other than deemed dividend as per Section 222E proviso to Section 234C. Advance tax applicable on income not subject to TDS like capital gains or casual income. Self-assessment tax SAT. Tax paid after deducting TDS and advance tax but before filing return. Filing of returns. Definition. Return of income is a statement of income and taxes filed by taxpayer. Person required to file the return of income. Section 139(1). Every person with taxable income must file return within due date. Due date for filing return of income. Normally the 31st of July for individuals. Extended for companies and auditors. Return of loss. Section 139(3). Return filed to carry forward loss for set off in future years. Belated return. Section 139(4). Late return filed after due date with some penalties applicable. Return of income of charitable trust and institutions. Section 139(4)(a). Specific return filing provision for charitable institutions seeking exemption. Return of income of political parties. Section 139(4)(b). Political parties required to file separate returns to claim exemptions. Return of income of specified association institutions. Section 139(4)(c). Special filing provisions for certain associations. Revised return section 139.5. Corrected return filed before completion of assessment or within specified period. Updated return section 139.8a. Allows filing or correcting return after assessment completion, excluding penalty for concealment. Defective return section 139.9. Return may be declared defective for errors or omissions. Taxpayer given time to rectify. Signing of returns section 140. Returns must be signed physically or digitally by the taxpayer or authorized representatives. Fee and interest. Interest and fees levied on late filing of returns or late payment of taxes. Interest for default in furnishing return of income section 234a. Interest charged at 1% per month for delay beyond due date. Interest for default in payment of advance tax section 234b. Interest charged at 1% per month if advance tax paid less than 90% of assessed tax. Interest for deferment of advance tax section 234c. Interest charged for deferment or short payment of advance tax installments. Fees for delay in furnishing return of income section 234f. Flat fees for late return filing ranging from 1,000 rupees to 10,000 rupees based on delay period and income level. Simple example: Mr. X's rent income attracts TDS at 10%. His landlord deducts TDS and gives Form 16A. Mr. X files his return on the 31st of July to claim credit for TDS deducted. Landmark case: Ito vs. SP Chengalvaraya Naidu 1980. Highlighted principles of procedural fairness in assessment proceedings. CIT vs. Dharmendra Textile Processors 2004. Clarified timelines and consequences of delayed return filings.